What if the closure of the Strait of Hormuz isn't a temporary disruption? Most people immediately think about oil when they think about the Strait of Hormuz. They think about gasoline prices, shipping costs, and inflation. And while those concerns are certainly valid, precious metals investors should be paying attention for a much bigger reason. Because throughout modern history, some of the strongest bull markets in gold and silver emerged after major energy shocks exposed deeper weaknesses in the global economy. The 1970s oil crisis comes to mind, and the inflationary turmoil that followed. The 2008 energy spike and the financial crisis that followed that as well. Each period looked different on the surface, but they shared a common theme. Rising energy costs created economic stress. Governments responded. Central banks faced difficult choices, and investors increasingly turned toward hard assets. Today, the Strait of Hormuz remains one of the most important economic choke points on Earth. Roughly 1/5 of global petroleum consumption moves through this narrow waterway every day. If that flow were disrupted for an extended period, the consequences could extend far beyond oil markets. Before we speculate about the future, it helps to examine the past. The first major energy shock occurred in 1973 during the Arab oil embargo. Oil prices surged, inflation accelerated, and economic growth slowed throughout much of the developed world. At the same time, gold had recently been released from its fixed exchange rate under the Bretton Woods system. Investors suddenly had access to a monetary asset that could rise freely as confidence in paper currencies declined. Over the next several years, gold entered one of the most remarkable bull markets in financial history. By January 1980, gold had risen from approximately $35 per ounce at the beginning of the decade to over $800 per ounce. Then came the second oil shock in 1979, following the Iranian Revolution. Energy prices surged again. Inflation climbed even higher. Confidence in policymakers deteriorated. Silver joined the rally and briefly approached $50 per ounce in early 1980. The third example arrived in 2008. Crude oil prices surged to nearly $147 per barrel. Initially, precious metals struggled during the financial panic as investors sold virtually everything for liquidity. But once central banks began injecting enormous amounts of stimulus into the financial system, gold and silver entered another powerful bull market. Silver would eventually rally more than 400% from its crisis lows. The common thread was never simply oil prices. The common thread was what happened afterward. Energy shocks exposed vulnerabilities that already existed beneath the surface. Investors then sought assets capable of preserving purchasing power during periods of uncertainty. The Strait of Hormuz is one of the most strategically important waterways in the world. Despite being only a few dozen miles wide, it serves as the primary export route for a large portion of the world's oil and liquefied natural gas. Countries throughout the Persian Gulf depend on this route to access international markets. Every day, tankers carrying millions of barrels of oil pass through these waters on their way to Asia, Europe, and North America. If the strait were closed for an extended period, the issue would not simply be the immediate reduction in supply. Markets would begin pricing in uncertainty. Businesses would question future energy availability. Governments would reassess strategic reserves. And investors would begin considering the possibility that the global economy may be entering a period of prolonged instability. History suggests that uncertainty often drives investment behavior more than the underlying event itself. Gold has repeatedly benefited during such periods because it exists outside the traditional financial system. Silver is often followed once investors begin preparing for inflation and monetary responses. Oil is not just another commodity. It is embedded throughout the entire economy. When energy prices rise significantly, transportation companies face higher fuel expenses. Manufacturers pay more to operate equipment and ship products. Farmers face rising input costs. Retailers ultimately pass many of these costs to consumers. This process can transform an energy shortage into a broad inflation problem. Unlike demand-driven inflation, supply-driven inflation is difficult for central banks to solve. The Federal Reserve can influence borrowing costs, but it cannot create new oil supplies. If energy remains constrained for a prolonged period, inflation may persist far longer than policymakers expect. And this is one reason why precious metals often perform well during energy crises. Investors begin looking for assets capable of maintaining purchasing power as the costs of goods and services continue rising. A prolonged energy shock creates one of the most difficult environments imaginable for central banks. Normally, the Federal Reserve combats inflation by raising interest rates. Higher rates reduce borrowing, slow spending, and cool economic activity. However, an energy shock creates inflation while simultaneously slowing growth. Consumers spend more on necessities and have less money available elsewhere. Businesses facing rising costs and shrinking profit margins. Economic activity weakens even as inflation remains elevated. This combination is known as stagflation. Historically, gold has performed well when investors begin questioning whether policymakers can successfully manage both inflation and economic growth simultaneously. So silver's situation may be even more interesting than gold's. Unlike gold, silver serves both monetary and industrial roles. It benefits from investment demand during periods of uncertainty, while simultaneously supporting modern technologies, including solar panels, electrical infrastructure, artificial intelligence systems, data centers, and electrification projects. The silver market has already experienced multiple years of structural deficits. Demand has consistently exceeded newly mined supply. If a prolonged Strait of Hormuz disruption creates inflation concerns and drives additional investment demand toward precious metals, silver could find itself under pressure from both monetary and industrial buyers simultaneously. Historically, those environments have often produced silver's most dramatic advances. One of the biggest differences between today and the 1970s is debt. Governments around the world carry significantly larger debt burdens than they did during previous energy crises. If growth slows while energy costs rise, governments may face pressure to increase spending, provide subsidies, support industries, and stimulate economic activity. That spending often requires additional borrowing. Historically, rising debt burdens have strengthened the long-term case for hard assets because debt is frequently managed through inflation, currency debasement, or financial repression. A prolonged energy shock could therefore reinforce many of the same conditions that have historically supported precious metals. Another potential consequence involves the international monetary system itself. A prolonged disruption affecting one of the world's most important energy corridors could encourage countries to diversify trade relationships and reserve assets. This trend has already been underway. Central banks have been purchasing gold at historically elevated rates in recent years, while some nations have sought alternatives to traditional settlement mechanisms. Gold benefits directly from these developments because it's a reserve asset that carries no counterparty risk. The longer uncertainty persists, the stronger the incentive may become for central banks to continue diversifying reserves. If the Strait of Hormuz remains closed for an extended period, the story is not really about oil. The story is about what happens afterward. Higher energy prices can fuel inflation. Inflation can weaken purchasing power. Slower growth can create impossible choices for central banks. Governments may respond with more borrowing, larger deficits, and additional intervention. Investors may increasingly seek assets that exist outside the traditional financial system. And that's why precious metals investors watch energy markets so closely. The bullish case for gold and silver is not based on a shipping lane alone. It's based on the possibility that a prolonged disruption could expose deeper structural weaknesses that already exist within the global economy. History never repeats exactly. The next crisis will not look identical to 1973, 1979, or 2008. But if those periods teach us anything, it's that major energy shocks often become catalysts for much larger monetary and economic changes. And when confidence begins shifting away from paper promises toward tangible assets, gold and silver have historically been among the primary beneficiaries.